post-market. Thursday, February 19, 2026. The closing bell rang exactly 15 minutes ago, and if you're staring at your monitors right now, you are looking at red across the board to end the session.
Yeah, definitely a heavy tape into the close.
S&P 500 down 0.28%.
Yep.
Nasdaq taking a hit, down 0.31%. And the Dow Jones, the real laggard of the session today, shedding 0.54%.
Honestly, it was a choppy mess. Just a really specific defensive tilt to the whole session.
Right. And if you're running a deep dive into the tape today, the sentiment shift from that winning streak earlier this week is glaring. It just evaporated.
It hit a brick wall.
Yeah.
But you have to contextualize this. I mean, we knew the neutral sentiment we've been writing was going to officially expire tonight anyway.
Because tomorrow morning we get the PCE inflation data.
Exactly. Tomorrow's pre-market PCE print is the hook for this whole week. Everything we saw in the tape today, every tick, was just positioning ahead of that number.
So let's tear into the narrative behind this move. Because looking at the headline numbers, down 0.25% doesn't scream panic. It barely screams correction.
No, it wasn't a panic. I want to be clear about that right off the top.
But if you were actually watching the intraday price action, today felt like a trap. It felt incredibly heavy.
It was a classic head fake session. If you want to understand why the mood soured so quickly and why we saw that defensive rotation, you have to look at the earnings story of the day. You have to look at Walmart.
The retail bellwether. And this is the part that trapped a lot of momentum players. On paper, they beat the street estimates.
They did. And that is what makes the price action so critical for anyone actively trading this market. Walmart gapped up at the open to 128.42.
So if you're just reading the headlines, you see Walmart beats, you see the green arrow at 9:30 a.m., and you probably hit the buy button.
And if you did that, you are severely underwater right now. Look at where it closed, 124.67.
That is an ugly intraday reversal.
It's massive. In the business, we call that a gap and crap. It is a textbook sell the news event.
So break that down for me. If the earnings were technically good, why the aggressive sell-off? Just institutions taking profit ahead of PCE.
It's deeper than that. The market is a forward-looking mechanism, right? The earnings beat was yesterday's news. That's the rearview mirror. The problem was their fiscal year 2026 guidance. It was weak. They are explicitly signaling a cooling consumer. And when Walmart, a company that literally tracks the spending habits of half the country, says the consumer is pulling back, the street doesn't just listen. It reacts aggressively.
Which casts a huge shadow over the entire discretionary sector. So the narrative shifts instantly from the consumer is resilient to the consumer is tightening their belts.
Precisely. And in a market that is currently priced for perfection, any crack in that consumer spending story is going to get punished.
But it wasn't just the consumer story weighing on the tape today. We had some pretty serious macro headwinds blowing in from overseas. It felt like the geopolitical stage suddenly intruded on the trading floor again.
Yeah, it really did. The friction in the Middle East is ramping up, specifically the U.S.-Iran tensions. That story had been dormant for a few weeks, sort of on the back burner, but it woke up today and it definitely spooked the desk.
You saw an immediate reaction in the commodities. Oil spiked, hitting 6-month highs.
Which perfectly explains why energy was the only real winner today.
Up 1.37% as a sector.
The clear leader. But you have to understand the correlation here for your portfolio. Higher crude is a direct tax on everything else. It's a tax on the consumer, and it's a huge tax on corporate margins. Just look at the airlines today.
American Airlines took a complete nosedive, down over 5%.
It's algorithmic. It's not because people suddenly stopped booking flights today. It's purely an automated reaction to rising fuel costs impacting their forward operating margins. The algos see crude spike. They immediately hit the bid on airlines. It happens in milliseconds.
Right. And we also have to talk about the financials. They slid 0.68% today. And there's a specific thread there we need to pull on because it's a bit more opaque than the oil story, the private credit chatter.
Oh, yeah. This is a story that's going to get a lot more traction over the weekend, and I think a lot of people missed it today because they were staring at Walmart's tape. Blue Owl Capital suspended withdrawals from one of their credit funds.
Suspending withdrawals, that is never a phrase you want to hear. That just screams liquidity issue.
Never. Gating a fund sends an immediate shiver through the financials. Private credit has been this booming, trendy asset class for the last 2 years, but the market is suddenly remembering that these are highly illiquid assets.
You can't just hit the sell button and get out.
Exactly. So when you combine that sudden private credit anxiety with the lingering hangover from those split Fed minutes we got yesterday.
The sudden realization that rate cuts are absolutely not guaranteed.
Exactly. You stack a cooling consumer, sticky inflation risks from an oil spike, and new credit jitters, you get this aggressive risk-off posture. It's a wall of worry being built brick by brick.
Okay, so we've got a cooling consumer, geopolitical spikes, credit fears. Sounds pretty grim. But there was one massive counter-trend hero today, a stock that just completely ignored the broader narrative. Deere.
The tractor guys.
Yeah, Deere closed up a staggering 11.6% in this market. That's a massive outlier. Usually when the Dow falls out of bed, the heavy industrials fall right down with it.
It bucked the entire macro trend, and there is a critical lesson in that divergence. It tells us that while the consumer side of the economy is looking soft, the Walmart side, the industrial side, is showing real resilience. Agriculture, heavy machinery, hard assets.
So Deere is basically acting as an institutional safe haven right now.
Absolutely. It honestly prevented the Dow from having a total meltdown today. You saw professional money rotating out of the mall and directly into the farm.
All right, so that's the surface narrative. But for this deep dive, we need to look under the hood. Let's talk about the market internals, because the tape is lying to us a bit. Let's start with the volume.
This is arguably the most important data point of the entire session. If you look at the SPY volume today,
we printed just 58.6 million shares.
Sure.
And for anyone who doesn't track that daily, our 30-day average is sitting all the way up at 84.5 million. That is a massive drop-off.
It's incredibly low. We are trading at roughly 70% of normal participation. It's a total ghost town.
So nobody showed up to the party.
It is a pure buyer strike. This is a very low conviction move. Traders are paralyzed. They're looking at the Fed. They're looking at Iran. They're sweating the PCE data tomorrow, and they are just sitting on their hands.
They're refusing to engage. Does that change how you interpret today's drop, though?
It definitely does. When the market bleeds out on light volume like this, it isn't necessarily institutional seller panic. It's not a frenzy. It's just that there are zero buyers stepping up to support the bid.
The bid stack is hollow.
Exactly. It's like stepping on a floorboard that isn't nailed down. You slip, not because someone pushed you, but because the foundational support just wasn't there.
What about the real money, though? The institutions. We saw some weird action into the close.
They were actively fading the rally today. Every time the large caps tried to push higher in the morning, institutions sold into that strength. They are trimming their peaks, not buying the dips right now.
But then you look at the Russell 2000.
The small caps, yeah, that was the anomaly of the day.
The Russell saw this really unusual last-hour surge and actually managed to finish green, up 0.25%. Why would risky small caps catch a bid when the big, safe mega caps are getting faded?
It looks like pure rotation and window dressing. A flight to quality in the large caps failed early on. People refused to pay up for tech at these valuations, so the money rotated. Professional desks de-risked their heavyweights ahead of the weekend and parked that cash in small caps and defensive plays.
Let's look at the breadth, too. Because the headline S&P index was basically flattish, down just that 0.25%. But the advanced decline ratio finished 1.2 to 1 negative.
More stocks fell than rose.
Which doesn't sound terrible on the surface. 1.2 to 1 is relatively balanced.
It isn't a disaster, no, but it highlights a major structural weakness in the tape. Tech heavyweights, the Sovereign 7, they're acting as a concrete floor right now. They're holding up the headline index price, while the mid-caps are just rotting underneath them.
The generals are holding the line, but the soldiers are in full retreat.
That's the perfect way to phrase it. And we are seeing a classic bearish divergence setting up here. The S&P 500 is hovering right near all-time highs. But if you look at the number of individual stocks hitting 52-week highs, that metric actually peaked 3 weeks ago.
That is a glaring structural fracture.
It is. In a healthy, sustainable bull market, price and participation move up together. Right now, they are diverging hard. The risk of a rug pull or a fast mean reversion correction of 3 to 5% is rising every day because the breadth just isn't there to support the scaffolding.
I want to pivot to something that might confuse a lot of traders looking at the scoreboard today. The VIX.
The fear gauge.
Right. So the market was red today. Stocks went down. The standard textbook correlation is that when stocks go down, the VIX goes up.
Usually. That's the standard playbook.
But today, the VIX actually dropped. It fell 6%, closing down at 13.45. How do you explain a falling fear index in a falling heavy market?
It's what we call a volatility crash.
Yeah.
The options market had priced in a massive amount of event risk for earlier this week. We were waiting for CPI revisions, waiting for central bank speakers. When that news hit the tape and it wasn't catastrophic, all that baked-in fear premium just evaporated.
The market exhaled. So even though prices drifted lower, the actual fear of a tail risk crash went away.
Precisely. The market is basically saying, okay, we might bleed lower, but we aren't going to gap down 4% tomorrow. And this VIX drop has a very real mechanical effect on the tape. It creates a gamma flip.
Let's talk about the mechanics of that gamma wall, because this is the setup for tomorrow. The critical level everyone needs on their screen right now is 5,950 on the S&P 500 ES futures.
5,950, that is the line in the sand. That is the zero gamma flip point. It's the exact level where dealer positioning violently changes.
Walk us through the two scenarios here. What happens to the tape if we stay above 5,950 tomorrow?
Above 5,950, dealers are trapped in long gamma. That means they are mathematically forced to buy dips and sell rips to hedge their books. They act like shock absorbers. They compress the range and keep things calm.
And if we break below 5,950?
That is the danger zone. Below that level, dealers slip to short gamma. Their hedging matrix reverses. Instead of buying the dip, they have to aggressively sell into the weakness to protect themselves.
So they become an accelerant.
Exactly. If we break and hold below 5,950 after the PCE print, you could see a rapid waterfall move down toward 5,880 because those shock absorbers are gone. The market makers are essentially hitting the gas pedal on the way down.
So 5,950 is the absolute trigger. Now let's get into some specific trade setups. For the listener looking to allocate capital tomorrow, what is the high conviction strategy?
Well, given this volatility crush we just broke down, the highest probability play is what we call the boring trade. Short volatility.
Hey, boring usually pays the rent.
It really does. You look at the mega cap tech sector ETF, ticker XLK, you sell out-of-the-money put spreads, you are basically betting on a sideways choppy grind. You want to capture the theta burn.
And since we expect dealers to dampen volatility as long as we stay above 5,950, you want to be the one selling that time decay.
You're literally getting paid to wait. If the market moves 1% up or down, you lose very little. If it stays completely flat, you sweep the entire premium. You're betting on boredom.
I love betting on boredom. But what about the momentum crowd? The traders who want to catch a real directional move tomorrow.
For momentum, you have to be looking at day two plays. Stocks that had a massive breakout on day one, and you're playing the continuation. Let's start with NVIDIA.
It always comes back to NVIDIA.
It's the king of the tape. NVDA had a genuine breakout today. It cleared the 145 resistance level on heavy volume. That was day one.
So what's the entry for day two? Do you just buy the gap up at the open?
Absolutely not. Never buy the open on a day two momentum play. That is exactly where amateur money gets trapped. You have to be patient. Watch for the morning retest. If NVDA dips in the first hour, but actually holds that 145 level, turning old resistance into new support, that is your execution trigger.
And the upside target?
152. The institutional momentum is clearly shifting back into semiconductors, and if 145 holds firm, the path of least resistance is straight up.
Okay, NVDA at 145, what's the second momentum setup?
Palantir, ticker PLTR.
A massive retail favorite.
It is, but the institutional footprint is all over it right now. It closed at the dead highs of the day. They dropped a surprise contract announcement mid-session, and technically this chart is setting up a perfect high, tight flag.
What's the specific strategy for an entry there?
Again, do not chase the open. You are looking for a morning dip to VWAP.
The volume-weighted average price.
Right. Institutional algorithms love to execute at VWAP because it mathematically justifies their entry to their clients. It's the ultimate support line. If Palantir pulls back to VWAP and holds, you buy the bounce. We expect a massive secondary squeeze as retail traders who missed the initial move today start chasing that day two continuation tomorrow.
Why the VWAP dip on PLTR? All right, let's zoom out one last time. We had a choppy, low-volume compression day today. Statistically speaking, what does that indicate for the Friday session?
This is where the math gets really exciting. Today was a textbook compression day. The trading range was incredibly tight. It's like a spring being pressed down. Statistically, after a session like today, there is a 62% probability of a trend day tomorrow.
A trend day meaning an explosive directional move where we open, drive, and never look back.
Exactly. The market has stored up a massive amount of kinetic energy. It has to release it. We cannot stay compressed in this tight range forever.
So how do we know which way that spring uncoils? Obviously, the PCE data is the catalyst, but what does the chart tell us?
You watch the open drive. The first 30 minutes of trading are going to dictate the entire session. If we break and hold today's high, which is 6,015.
6,015 on the ES.
Yes. If we clear 6,015, there is a 75% statistical chance of continuation to the upside. The market uncoils upwards, the dealers buy to hedge, the short sellers are forced to cover, and it just fuels the fire.
But if we fail there, We're looking right back down at that 5,950 gamma flick level.
And if 5,950 breaks, the spring uncoils straight down.
I want to leave you with one final thought before we wrap this deep dive. We've mapped out the 5,950 danger zone on the downside. We've got the 6,015 breakout level on the upside. We're all hyper-focused on this PCE print acting as the match. But what if the data comes in perfectly in line? What if it's a total non-event?
Then the dealers keep us pinned.
Exactly. We are mathematically coiled for a trend day. But if the macro catalyst doesn't force the institutional hand, you could be staring at another brutal session of theta burn. The real risk tomorrow might not be a waterfall crash or a massive melt-up. It might just be absolute paralyzing boredom that traps the momentum chasers.
That is the real danger of a volatility crush. Do not force a trade if the market refuses to break the range. Wait for confirmation.
Keep your size small until a level breaks. Stay sharp. Watch the bell.